Namaskar, everybody. Welcome to today's show. And today's topic is about the portfolio management strategies for the retail investors. So, before starting today's topic, मैं आप सबसे एक जनरल क्वेश्चन पूछना चाहूँगी और इस क्वेश्चन के लिए है कि अगर हम बात करते हैं पोर्टफोलियो मैनेजमेंट स्ट्रैटेजीज़ या इंडिविजुअल पोर्टफोलियो की, तो आप सबके ही माइंड में उसको देखकर क्या क्वेश्चन आता है? आई एम श्योर दैट मोस्ट ऑफ़ यू विल टेक सम टाइम और आपको ऐसा लगेगा कि इसका हमें आंसर क्या देना चाहिए। तो इसलिए ये दिखाता है कि आप लोगों को फाइनेंशियल प्लानिंग के लिए या आपके फाइनेंशियल पोर्टफोलियो के लिए समझने की एक बहुत इसमें आवश्यकता है। आज का टॉपिक जो है हम लोग उसमें कवर करने वाले हैं अपना इक्विटी, फिक्स्ड इनकम एंड ऑल्टरनेटिव इन्वेस्टमेंट्स। इट विल ऑल्सो इंक्लूड रिगार्डिंग द डेट्स एंड देन हमारे पास होगा पर्सनल फाइनेंशियल प्लानिंग, रिस्क मैनेजमेंट, इंश्योरेंस प्लानिंग एंड रिटायरमेंट प्लानिंग। बेसिकली व्हाट इज़ इन्वेस्टमेंट? अगर हम देखें तो इन्वेस्टमेंट इज़ अ कमिटमेंट ऑफ फंड्स टुडे विद एन एक्सपेक्टेशन ऑफ अर्निंग सम रिटर्न ओवर अ पीरियड ऑफ टाइम। हम एक कोई भी अपना मनी दैट वी हैव अर्नड, आज हम एक जगह अगर इन्वेस्ट करते हैं एंड वी एक्सपेक्ट दैट वी हैव टू अर्न सम रिटर्न ओवर अ पीरियड ऑफ टाइम इज़ व्हाट वी कॉल इट एज इन्वेस्टमेंट। एक इन्वेस्टमेंट है, करंट कमिटमेंट होती है जो आज के पीरियड पे हम करते हैं एंड वी एक्सपेक्ट कि हमें एक उस पर रिटर्न आए ओवर अ पीरियड ऑफ टाइम विच मे बी 5 years, 10 years and beyond that. And that will compensate the investors for the time that for which the times funds have been committed. एक उस what is the expected rate of inflation that the investor is expecting and what is the uncertainty of the future payments. कि कितने टाइम पीरियड के लिए, कितने टाइम ड्यूरेशन के लिए हमने अपने जो इन्वेस्टमेंट है, जो फंड्स है, वो इन्वेस्ट करना चाहते हैं 5 साल के लिए, 10 साल के लिए। एक वो बहुत बड़ा सोर्स है कि हमें कितना इन्वेस्टमेंट और किस सोर्स में करना चाहिए। एंड आफ्टर दैट व्हाट इज़ द एक्सपेक्टेड रेट ऑफ इन्फ्लेशन, मार्केट में हमारा इन्फ्लेशन रेट क्या चल रहा है, वो देखकर भी हम अपने आगे के फ्यूचर के फाइनेंशियल प्लानिंग के डिसीजंस जो है वो लेते हैं। देन अनसर्टेनिटी अबाउट द फ्यूचर पेमेंट्स। व्हाट इज़ अनसर्टेनिटी? अनसर्टेनिटी इज़ कोई भी आगे हमारी पॉलिसीज़ के लिए और फाइनेंशियल कंडीशंस क्या होती है उसको देखकर आज हमें एक डिसाइड करना होता है कि दैट व्हाट इज़ द अमाउंट ऑफ इन्वेस्टमेंट दैट वी नीड टू डू टुडे। व्हाट आर द ऑब्जेक्टिव्स ऑफ इन्वेस्टर्स? द ऑब्जेक्टिव्स ऑफ इन्वेस्टर इंक्लूड टू मूव मनी फ्रॉम द प्रेजेंट। आज हमारे पास किस हालात में हमारे पास मनी है और हम उसको कहाँ इन्वेस्ट करना चाहते हैं फॉर द पर्पस ऑफ मीटिंग सम गोल्स दैट वी हैव डिसाइडेड फॉर आवर फ्यूचर रिक्वायरमेंट्स। एंड उस प्रोसेस में एक हम एक्सपेक्ट करते हैं टू अर्न अ सर्टेन अमाउंट ऑफ रिटर्न फॉर बेयरिंग द इन्फ्लेशन एंड द रिस्क। इन्वेस्टर को इन्वेस्टमेंट करने से पहले कई सारे अपने रिस्क जो होते हैं वो कॉन्स्ट्रेंट्स होते हैं जो इन्वेस्टर अपने माइंड में रखता है बिफोर इन्वेस्टिंग, विच इंक्लूड्स लिक्विडिटी, एज, नीड ऑफ रेगुलर इनकम, टाइम होराइजन, risk tolerance and the taxability. What is liquidity? Liquidity is if we are investing a percentage of fund in some sources and we need money today. So what is the amount, what is the chances that it will be available today in hand? So this is basically what is meant by liquidity. What is the age of investor? अगर there are investors who are investing at the age of 20, there are investors who are investing at the age of 50. So what is the age? What is our age so that we should start thinking about the investment decision? It is one of the major constraint that an investor is having. The next important point that we have is need of regular income. Like what is our requirement? हम कितने टाइम में अपना रिटायरमेंट प्लान कर रहे हैं एंड उसके बाद हमें कितना अपना रेगुलर इनकम की रिक्वायरमेंट है, टाइम फ्रेम हमारे पास कितना है, व्हाट इज़ द टाइम फ्रेम दैट वी आर एक्सपेक्टिंग, हमारा रिस्क टॉलरेंस क्या है। कई इन्वेस्टर्स ऐसे होते हैं जो कि एक ज़्यादा रिस्क लेने को तैयार होते हैं। दे आर सर्टेन इन्वेस्टर हु डोंट वांट टू टेक रिस्क एट ऑल. सो दिस इज़ ऑल्सो अ पॉइंट that is to be considered while making any kind of investment decisions. After that, last but not the least, we are having a point of taxability. हर इन्वेस्टमेंट के सोर्स का उसमें जो इंटरेस्ट इनकम आती है, देयर आर डिफरेंट काइंड ऑफ टैक्सेबिलिटीज दैट आर एप्लीकेबल टू दोज सोर्स ऑफ इन्वेस्टमेंट. So before taking any kind of investment decision, we should consider what is the taxability factor for that. For example, अगर हम पब्लिक प्रोविडेंट फंड की बात करते हैं तो उसका जो इंटरेस्ट होता है वो टैक्स फ्री होता है. एंड सिमिलरली इफ़ वी टॉक अबाउट अदर सोर्सेज ऑफ इन्वेस्टमेंट लाइक इक्विटी, debt, so there are different kind of provisions of taxability for these sources of investments. So there are basically 5 building blocks that an investor should keep in mind before starting investment, and these different kind of things should be taken into consideration, like income. What is your income? What are your earnings? If you have borrowed any kind of money from any other financial institution or sources, which is called the borrowings, then we have what is our spending, then what are the expectations. So these are the certain 5 building blocks then one should keep in mind before taking any kind of investment decisions. Then why one should invest? What are the various factors that one should consider before investing? First of all, investment increases your income. Investment provides you a extra income, which you can say it as an passive income in addition to what you are currently earning. Investment reduces your tax liability. Various kind of tax rebates are available on different sources of investment. Like again, for PPF, you will get a deduction under Section 80C of the income tax. And the next thing that why one should invest is to fight inflation. What is inflation? Inflation is basically something which reduces our purchasing power. The increase in day-to-day expenses and due to the various factors, due to the economic conditions that are prevailing, जिसकी वजह से हमारा सपोज़ करते हैं कि आज हमारे पास 100 रुपये है और 100 रुपये में जो हम चीज़ खरीद सकते हैं, दैट डजंट नेसेसरीली मीन्स कि आने वाले 1 साल या 2 साल के बाद भी हम सेम अमाउंट ऑफ रिसोर्सेज 100 रुपये में परचेज़ कर सकते हैं, बिकॉज this is the inflation factor that the things are getting expensive. So it is very necessary to take investment, to make investment decision, ताकि हम अपने जो कॉस्ट है, अपनी जो हमारी इन्फ्लेशन है उसको फाइट कर पाए. Next, it also increases our savings. Savings, as we all know, are a very important part for anybody's life. So it can be used in any kind of uncertain situations or anything. So savings are the most important things, and it is one of the most important reason that why should one be investing. So one should not save, one should not consider, or one should not save after considering that this is the amount of income that one is earning and this is my expenditure, and the remaining amount that is remaining after the expenditure I will be saving. But one should consider that this is the amount I am expected to save to accomplish my future goal, and accordingly one should consider their expenditure according to the amount of saving that they are expected to make. If we talk about the equity, fixed income and alternative investments, then investments are generally bucketed into categories. There are various kind of categories in which investment can be classified, and within each category there are many different type of investments. So as an investor, you have to decide that on which investment category you want to invest in and which category will serve your investment objective quite well. So there are multiple options that are available in the market, but ultimately it's your decision according to your financial and future goals that in which source of investment you want to contribute. What is a financial security? A financial security is an instrument that is representing some type of financial value which is both fungible and tradable. The entity that issues the security as financial security is known as the issuer, and the buyer, the investor, will buy these financial securities to make their investments. And the different kind of financial securities will differ on the basis of their risk and the return characteristics. So financial security is an instrument, and for the various kind of examples of financial security can be in equity, the stocks, the debts. These are the various kind of financial securities that are available in the market. So the different kind of financial security can differ on the basis of their risk and the return characteristics. There are basically two broad categories of financial securities, and these are the debt which is having the fixed return and lower risk rate. And in comparison to debt, we are having equity, which is having variable return and higher risk. So equity is basically the in equity, if you are in the market and you want to invest in financial security, equity is a good option. Equities give you the controlling and the ownership rights in a company, and in this market rate effects. So the risk accordingly in the equity is more as compared to the debt. Debt is having the fixed income, and but the risk is also less in debt. Accordingly, if there is an investor who is going to take who is ready to take the high amount of risk, he can definitely invest in equity. And if someone is low or risk averse investor, or is ready to take moderate risk, then debt is a good option for that. So there are the basic facts that we should consider before investing. Like, some investments can be in the form of securities, while some investment and the other investment can be in the non-security form of investment. What is non-security form of investment? The non-security investments are those financial are not non-financial securities that which cannot be traded in the market. Like, we are having jewelry is there, and we are having antiques or fine art is there. So this is also in form of non-security investment. And the second point is, investing in financial security is different from investing in real estate. So financial security is definitely different from what we are expecting from real estates in terms of both risk as well as the return. So it is very important before taking any kind of investing decision to understand the relationship between the risk and the return of the security. There are certain securities in the market which are free from risk. Like there are government bonds in which there is a fixed income and there is no risk. So according to the nature of the investor, if an investor is going to take high risk, and if an investor is a risk averse investor, so they can definitely prefer to go for risk-free securities. And accordingly, if we are expecting high amount of return, then we should be, and as a investor, we should be to take a high amount of risk. So in more than if there are certain like high risk securities, medium risk securities, and low risk securities in the market, and accordingly the return will also variate and fluctuate depending on the nature of the securities that we are ready to take. So what is an asset class? Before taking any kind of investment decision, we need to decide what is an asset class. Asset class is basically a family of investments with similar features, like they're having certain similar feature. They are having risks, the returns, liquidity is there, tenure is again something, taxation, market volatility is there, which is as per the prevailing economic scenario, investors' rights, etc. It serves as a specific objective in the investor's portfolio. So different kind of asset classes are: cash is one of the asset class, stocks are there, then bonds are there, commodities are there, real estate is there, jewelry is there. So these are the kind of asset classes which an investor can consider before making any kind of investment decision. So each asset class is usually governed under the same laws and regulation, and the asset classes contain financial security which behaves similarly to one another in the marketplaces. Another important feature that needs to be considered while taking any kind of portfolio management decisions is allocation of assets. It has been generally observed that a successful portfolio depends basically on the allocation of assets and not in which securities the investment has been made. So it is very important to identify in which class of assets allocation of funds are to be made. And we all must have heard to the statement that do not ever put all your investment in a single bucket. So to have it is important to have a diversified bucket of investment, which also helps in diversification of risk. For example, do not put all your money in real estate, or do not put all your money in financial securities, or do not put all your savings or all your investments in any kind of particular scheme. So always have a diversified portfolio to take the maximum return and the advantage of all the available asset classes. Asset allocation also involves dividing an investment portfolio among different assets and categories such as stock, bonds, cash. The process of determining the mix of the asset is to hold your portfolio in a very personal one, and which is according to the amount of risk and the return that an investor is ready to take. So the asset allocation that works best for you at any given point of time in your life will depend largely on your time horizon and your ability to tolerate the risk. Asset allocation is considered as the most important decision that an investor must take. And the key determinant of investment outcome is not the selection of individual securities, but the allocation of funds among the various asset classes. So, there are various approaches to asset allocation. The first approach is strategic asset allocation. Strategic allocation heavily relies on the diversification to limit the risk and seeks to improve the returns. इसमें investment is basically based on the expected rate of return for each class of asset. The next allocation strategy that we have is the dynamic asset allocation, which regularly adjusts the combination of asset an individual has invested in the market. As the market rises and falls, it automatically adjusts itself as economy strengthens or weakens. Therefore, the fund manager or the individual sells asset that declines in value and purchases the asset that increases in the value. It will balances the portfolio and maintains the overall return of the portfolio. In dynamic asset allocation, आपका रिटर्न जो है वो ऑटोमेटिकली बैलेंस आउट हो जाता है ऑन द बेसिस ऑफ द सिनेरियो दैट इज हैपनिंग इन द मार्केट. The next approach we have is the integrated asset allocation approach. This approach basically considers the factors which is like individual's economic expectation, what is his or her the capacity of tolerating the risk. Unlike the other strategies, integrated asset allocation strategies considers the investor's risk appetite. So in this particular asset allocation strategy, the risk appetite is most important thing which is considered. The next is the insured asset allocation. It requires establishing a floor value for portfolio return, and active management is carried out till the portfolio achieves return above this base. So next we are having what are the various financial investments and the risk. So generally risk level has been identified into three kinds: the aggressive one, the moderate one, and the conservative one. So if an investor is risk aggressive, the investor would like to basically invest in the equity. This is called the aggressive investment strategy, and mostly in that particular approach, the amount of asset allocation, the maximum weightage would be given to the equity, because in this return is also higher as compared to other sources of investment. And for a risk conservative or for a risk averse investor, the bank's fixed deposits and the other government deposits are the best source of investment, because at that in those particular sources of investment, the amount of risk is very low. Then for the investors who are risk moderate, so there are other options also, like there are medium risk securities, and there are investment linked insurance options also. There are corporate bonds, asset backed securities, etc. So they have a good amount of return along with less or the moderate kind of risk as compared to the equities or as compared to other high risk securities. So there are some kind of key features for investing management. First is magic of compounding. So what is compounding? Compounding is a concept in which money is expected to multiply, and that multiplication is called compounding. Suppose if we assume that there is an investor X, and investor X starts investing at the age of 30, and uh, he or she invests at the rate of 10%. Then at the time of retirement, or at the time of attaining 60 years of age, the investor would be having approximately 1.1 cr balance as or 1.1 cr corpus fund, which is because of compounding. In compounding, the interest which is received on a basic or principal investment is again added, and then the interest is calculated on that. So this is generally called the eighth wonder of the world, and this is the magic that the compounding have on the investment. The next key feature of investment management is variability of interest rates. Again, the interest rate varies in each kind of investment. So this is a feature that one should know while taking any kind of investment decision. The long-term equities, they generally have long-term return. Then impact of inflation, as we have already discussed, that the impact of inflation should be considered while taking such kind of decisions. Another point is a risk return trade-off. The higher the amount of risk, the higher the amount of return, and the lower the amount of risk that one investor is going to take, the less would be the amount of return that can be expected from that particular security. So there are other major types of alternative investments, and these are commodities, that is the physical material or the natural resources, and the precious and the industrial material that one is interested in investing in. Then the collectible items, like the tangible items whose value increases over a period of time, like books are there, stamps are there, jewelry is there, coin is there, etc. Real estate, which will include the physical property and the raw land. Then we have private equity, investments which are not publicly traded, and which include limited partnership is there, private company is there, stocks are there, hedge funds are there, debts are there. Then we have derivatives also. Derivatives are the assets, or derivatives is a contract between two parties which is built on a purpose of speculation, and which defines, or which has attains its value from any kind of asset which is underlying. So there can be future options as well. Swaps are also there. Next, we will talk about the individual investors' life cycle. So, according to the age at which an investor is, the needs or the requirements are different. So, there is a life cycle of an investor. Like at the age of 25, there are long-term goals like retirement, children's education, and there are short-term goals as well, like buying a car or a house. At a consolidation phase, which nearly comes around 40 to 40 years of age, the long-term goal is retirement, and the short-term goal can be going for a vacations or children's education. These can be short-term goals. Then the distribution phase, which comes normally at the age of retirement or above 60. The long-term goal can be estate planning, and the short-term goal can be one's lifestyles, other maintaining the standard of living. So this is investor's life cycle, according to which one should assess the need and see that these are the goals, and this is how we are going to attain it by investing in a right form of the asset or the securities. So in general scenario speaking, PPF account are tax savings that provide all safe and steady returns. Shares can be rewarding for long-term investors. SIPs leads to disciplined savings and investing. Insurance is a cushion for the unseen events. Gold is a safe option for investors, and liquidity for any kind of investment is very crucial. Next, we will be talking about the personal financial planning, the risk management, and the retirement planning. What is financial planning? Financial planning is the process of developing certain strategies to achieve financial goals through a well-crafted and executed investment plan. It covers basically the cash flow management, the retirement planning, the insurance, and the tax management that one is having. So, there is a general saying that is, a goal without a plan is just a wish. So, if you want that your wishes should be completed, then it is very important that you plan accordingly and then you form goal according to that. So, planning is very important, setting goal is very important to complete or to make true your wishes. For investors who have knowledge and time to analyze individual investments, direct investing is a very good option, which requires having an online trading account. Bigger sum of money are needed to get good diversification. The services of a trained financial planner or a broker house can also be taken for such kind of investors. For investors who have big sums of money but they lack some kind of knowledge or time that how to analyze that particular investment, portfolio management services are available, but the minimum investment in portfolio management services is rupees 50 lakhs or more cost that can be taken. So I hope that today's session is really would be helpful for all the retail investors who are going to take future financial decision or future investment decisions. And I really hope that it will provide you insights that how to take financial decisions. So 6 step processes to personal financial planning are: first of all, assess your current financial situation, then develop your financial planning goals, and accordingly you should start investing. You can also review and revise your financial plans based on the life changing situations. So review is always an important part of any kind of decision. So once you decide that this is the investment plan, you should definitely review it for as per the needs and the strategies that you would be developing for your future requirements. So an appropriate investment portfolio can be designed only after developing a risk profile of the investor and an investment of the investor's risk category. Investor's risk assessment forms the basis for portfolio allocation, which is also referred to as the portfolio or simply the investing mix. So there are certain asset allocation which is as per the risk criteria or risk index that an investor is going to take. And one of the main factor or way of distinguishing between the class of asset is income and the growth. So I would like to thank you all of you for attending today's session. Thank you.